Urs, excited to be back here on the Swiss View with you. Crazy news from Black Friday, the largest ever sales day of a Black Friday since its kind of creation, inception, whatever we want to call it. But there's some interesting details when you dive down into the numbers. Maybe you could give our listeners a sneak into kind of what those numbers were saying.
Yeah, definitely. I mean, it's ever rising. So every year it seems that sales are higher and higher. But if you look into the numbers, oftentimes you also see that it's just the prices that rise. And what becomes interesting is that even so, I mean, at the end of the day, they had more revenue, which is all right. But the question also is, how does it come into existence? And what we have as longer as more is that AI-driven chatbots that they help consumers to find the best deals.
Which I think is really interesting, especially because when you look at the numbers, this kind of Black Friday sales was the least efficient in terms of like good deals, of where people
Correct.
really got a reduction on something that they were looking for,
Mm-hmm.
which I think is really interesting. You know, it's not, they're using AI to try to figure out where they could find the cheapest product, whatever they wanted to find. Already with the concern of the tariffs in the US specifically, we're talking mostly US, but specifically, where can I find the deals because of these tariffs that are rising? And at the end, they still had, what was it, about 7% more was the increase in prices that they were paying. So less of a bargain than would have been experienced even a year ago.
Yeah, but I think it's also this mentality or like the expectations of higher prices coming in next year again, because we had this for a couple of years now. I mean, inflation started picking up in 2021. That's 5 years ago almost. And so people are aware that even if I get a worse deal on a product than I did a year ago, in a year forward, it will be even worse because the price will be higher, and maybe I still get 30%, but 30% from a higher price are still more than what I would pay today.
Yeah. And it's, how do I say that? That has been the ongoing concern of the U.S. economy for a long time. When you have running inflation over the past 20 years, if you average it over 2%, 2.5, so you can find deals, which is somehow would feel like a relief at the moment, I would say, with U.S. inflation sitting at about 3%, pretty solid, especially when we look at core and normal inflation. And it's never returned back to 2% of what they've been searching for 5 years now. And I think kind of brings us into what we're looking at next year, with a lot of things going to be happening. I mean, Jerome Powell, the Fed chairman, is almost assuredly going to be replaced.
Yeah.
A lot of speculation on who's going to replace him. What we've seen is it looks like Kevin Hassett, who is a long-time economic analyst or holding economic how do you say that, positions for presidents all the way back from George Bush, through the first term of Donald Trump, now in the second term of Donald Trump, sitting on one of the councils of economic affairs, I believe. And what is their plan, right? What is the Fed plan moving forward? Is it to get rid of inflation? Because they still tout, even I was at an economic review from a U.S. economist last week who also stated inflation is not an issue in the US. 3% for me, that is an issue.
Yeah, I mean, it's the question is not only where is inflation right now, but it's also where it is going. And many economists and many experts, they are having the expectation that inflation is like decreasing, and whether it will be or not is very hard to say, especially with the new chair that might come in next April, whether it will be Hassett or Stephen Miran or anybody else. It is pretty clear that it will be someone Trump likes. And Trump likes to have lower interest rates. And lower interest rates oftentimes go with higher inflation, even though not directly. I mean, there are many other aspects that are playing into it. It also is a question, okay, how much money actually flows out into the economy, but it will certainly not be lowering inflation.
Yeah, and I think that's the challenge. Is we did see inflation on a downward trend.
Yes.
But it's then now bounced. And if we look at, not just the Fed chair, right? The Fed chair actually has a lot of power, but it's all the other chairs sitting there too, of the other Fed board members.
Yeah.
And we've already started to see this decrease in interest rates for, this year. It's looking like there'll be about 5 cuts by the end of the year, most likely. I mean, today we're recording this on the 8th of December, so listeners aren't going to hear this until maybe the end of the month, and the decision rate is probably taking place, but it's looking like it's going to be another 25 basis point drop. And I think, currently where it's sitting would be nice if there's just some stability to try to at least cool it off, or at least have it in a holding period to see if it pushes down inflation a little bit more. But it doesn't look like that's going to be the case. And then once the Fed chair is replaced, I mean, sky's the limit, or I guess the ground is the limit to see how low they go. But that's not the only issue, as you mentioned. That's the expanding Fed budget sheet, how much the M2 is being printed, and how much is being put in the economy.
Yeah, and also when you talk about inflation is always put together by different prices, by different products, and how much they cost. And we had, what was it, a year ago, we had this huge discussion coming up in the US, how much eggs cost. And we always had the discussion how much gasoline costs. And even so, if inflation might stay stable, it could still be that certain products become more expensive, which are products the consumer is focusing on, while other products or services will decrease in prices where it has not that much of an impact on the today's consumer.
Yeah, and I think that's always the challenge, right? Of how much is perceived inflation, how much hits the population on a wide spread, or at least even in the soft. I mean, kind of coming back to this Black Friday deal, right? Things are getting more expensive, and that's part of the reason that they had such revenue growth in terms of those numbers. And I mean, with the midterm elections coming up next year, like every politician does in the US, every government incumbency, they try to make things as good as possible leading up to it. And the question is, how much can they? And where will that go? We will see.
Yeah, and I mean, the discussion is also here, like the midterm elections are coming up. The current government wants to have a smooth economy, so they will do whatever is necessary to do so. And I think that also plays a little bit into the consumer sentiment of the US consumer. Even so, we saw numbers where the consumer confidence at least is turning negative. But at the end of the day, what Americans do understand is how their politicians work. And they know, I mean, with the current government and with the midterm elections coming up, we probably will see lower interest rates. We will probably see more stimulus. So we will see things that will increase like the picture of the economy, how it looks like to the world and to the Americans. But there the point comes in to the world. What does it look like to the world? And there it comes in, what effect does it have on the currency, on the US dollar?
Yeah.
And what we have seen with the rumors about the new Fed chair is that the markets, the equity markets, liked it quite a bit, but the fixed income markets or investors, they raise concerns. They said, look, if we have lower interest rates, still high inflation, I mean 3%, whether you like it or not, is still 1% more than what the target is. And I know that the Fed changed their strategy to achieve a 2% inflation over the long term, whatever that means. But that's how they justify it. But if the fixed income markets and the currency traders don't like it, they will send the US dollar further south. And that's what I could very well imagine that will happen.
Yeah, and I think it's a huge point to bring up, because one of the things that we talk about often is preserving purchasing power. And how do you do that? Well, you outpace inflation, essentially. It's a little bit more complex than that, but boiled it down to the simplified version, outperform inflation. And so if I'm in equity and there's more money being pumped in, the value of what I'm doing might go up. And might go up faster than inflation. Therefore, I'm creating more value. I'm beating inflation. But with fixed income and currency traders, those movements are less strong usually. You don't see 1,000% up. You don't see 10, 20% up a year with those. In most cases, they're smaller, more stable movements. And so that inflation figure matters a whole lot when it comes to the actual value that you're generating as an investor, as a product, as something that you're doing. And if you're in fixed income and there's low interest rates and high inflation, it is a incredibly difficult market to be in.
And that's also the reason why equity markets worked out so well over the last 15 years, especially between 2012 and 2018 and 20, where just interest rates were very low. And so there was kind of no alternative. I mean, the term TINA, there is no alternative, was brought out during that time, that it's like equity is nothing else because nothing else pays enough.
Yeah. And I think that's kind of trying to look, then globally at what's happening around the world. How do you then search for stability, but also find kind of that position of, okay, well, how do I diversify myself? And we look at, the U.S. markets have been pretty interesting this year, starting out really poorly and seemingly doing really well to this point now, even, 15, 16% above where they started the year, even though they were down 10%, 15% at the beginning of the year. And it shows kind of this back 3-year picture of back-to-back in the U.S. of this upward movement, even though there was this challenge, and there's a lot of money being thrown at the U.S. markets. And we see something a little bit different. Like in the U.S., you see uncertainty brings volatility. In Europe, what we've seen this year is even with uncertainty in the U.K., in France, in Germany in some cases, there's uncertainty, and there has been some pullback, but it has been less strong because they're thinking in a different mindset, right? It's not quarter to quarter, month to month performance. They're thinking, okay, where's the long-term picture?
Yeah, and I think it's also, it pretty much shows the different mentality between the two continents. I mean, the old continent, Europe, is just way slower in reacting to certain things, but they also do not react as quickly to bad news. I mean, we discussed in the past, we discussed what is happening in France with the budget dispute. We discussed what is going on in the UK. Also, the budget is a concern, the same in Germany. And yeah, it is a concern. It is talked about, and there are certain reactions. There are certain days where there is even an overreaction, but it's never to the extent as what we see in the US. In the US, it's full steam, and if it doesn't work anymore, then it goes full steam the other way. So the US market is just, it's priced to perfection. And people know that. People get nervous, but they know they don't want to leave the party early. And so the question is, who will go or who will leave the party too late?
Yeah. And I think that's the other side, is even when you look at in terms of like pricing of markets, the European markets are still a little bit more attractively priced, maybe a little bit. I'd say they are way more attractively priced than the U.S. markets at the moment. Now, it's not saying that it's a total disconnect, but it's something where investors are trying to think, okay, if I think long term, where can I get the best deal right now?
Yeah.
And right now, that's not necessarily in the U.S. Or at least there's a little bit too much uncertainty to say, okay, I will pay 56 years the price to the company's earnings because it is the future, right? And what's the drawback, right? And that's always the challenge of looking at companies of, where am I going to allocate best for the long term for certain investors, especially how we look at it.
Yeah, definitely. And I think, like, as a conclusion to all of that, I would not suggest to pull out of the US market totally. I think there is, as I said, with the midterms coming up, there is some potential left, but just be aware of what the risks are, how highly valued the markets are, and be diversified. So be ready that you're not blown off once the markets start to turn.
Yeah, I think to your point, it's absolutely the time to take the deep breath, evaluate your strategy. Does it hold up for your long-term picture? And then start talking to the professionals about how that fits into your overall investment picture. Urs, thank you so much. I look forward to doing this next time with you.
Likewise.